The S&P 500 is up 8.5% this year. The Russell 2000 is up nearly 19%. Both of those are genuinely impressive numbers. But there is one number sitting inside this week's market data that almost nobody is talking about. The Philadelphia Semiconductor Index is up 81.5% in 2026. Not 8%, not 18%, 81.5%. That is not a rally. That is a complete repricing of an entire industry. And if you do not understand why it happened, you are going to keep misreading every AI headline that comes across your screen. So today we are going to fix that. We are going to explain exactly what is driving this number. We are going to show you the structural shift underneath it, and we are going to walk through what it actually means for your money right now. Because this is not just about chip stocks. This is about where the biggest returns in this market are being built. Let's start with the obvious question. Why semiconductors? Why are chip companies up 81% when the broader market is up single digits? The simple answer is AI, but that answer is incomplete. And the incomplete version is what most people are acting on. Here is what is actually happening underneath the surface. AI does not just need chips to think, it needs memory to function. Massive, continuous, always-on memory. And the amount of memory AI systems are consuming right now is unlike anything this industry has ever seen before. Let me give you a specific number that will make this real. In 2020, AI data centers used roughly 10 terabytes of high-bandwidth memory globally. In 2026, that number has reached approximately 18 petabytes. If you are not familiar with the scale difference, a petabyte is 1 million gigabytes. We went from 10 terabytes to 18 petabytes in 6 years. That is not growth. That is a complete transformation of what the technology requires. And chip companies that build that memory are the direct beneficiaries of every dollar being spent on AI infrastructure. Hold that thought for a moment, because there is a second layer to this story that changes how you think about which companies win from here. The newest generation of AI chips does not just use more memory than older chips. It uses 7.2 times more high bandwidth memory per chip. And at the full system level, the jump gets even bigger. A complete AI system built today uses approximately 65 times more memory than previous generation systems. 65 times. That is the number that explains why semiconductor stocks are up 81.5% this year. Every AI deployment anywhere in the world is multiplying memory demand in a way that most investors never modeled into their expectations. This is not a cyclical chip boom that follows the old PC or smartphone upgrade cycle. This is a structural demand shift. It does not stop when consumers stop buying phones. It accelerates every time a company builds a new data center or deploys a new AI model. Now here is where the practical investing problem begins. Most everyday investors look at this 81% number and assume the trade is already over. They see huge gains and assume the opportunity is gone. That instinct is understandable, but it misreads what a structural demand shift actually means for prices over time. Think about what happened to cloud computing stocks between 2015 and 2020. Everyone who said the trade was over in 2017 because valuations looked stretched missed the largest portion of the gains. The same logic applies here. When demand is structural, meaning it does not reverse with the economy or the news cycle, the repricing of the companies serving that demand tends to run further than most people expect. By 2028, industry projections show servers will account for 59% of all global DRAM demand. That is up from 37% in 2023. Enterprise solid-state drives are on track to represent 65% of NAND memory demand, up from 18%. These are not marginal shifts. These are wholesale redirections of where an entire industry's revenue comes from. And most everyday investors are still building their understanding of chip stocks on the old consumer electronics model. That framework no longer fits the market we are actually in. If you are finding this useful, consider subscribing for more practical financial insights. So what does this mean for someone sitting at home trying to figure out how to think about this? Let's walk through this by income level. If you are just starting to invest with smaller amounts, the most accessible entry point to this theme is through semiconductor ETFs. Funds that track broad chip sector exposure give you diversification across multiple companies rather than concentrating risk in a single stock. You participate in the structural trend without betting everything on one company's earnings report. If you have an existing portfolio and are thinking about sector allocation, the question worth asking is this: does your current exposure reflect where AI spending is actually going? Most balanced portfolios are still heavily weighted toward the software and consumer-facing tech companies that get the most headline attention. The hardware layer underneath those companies, including memory chips and the infrastructure that makes AI run, is often underrepresented. That gap between where attention goes and where structural demand actually lives is precisely where pricing inefficiencies tend to exist. If you are a more experienced investor already watching individual names in the semiconductor space, the memory chip segment specifically deserves attention. The shift from general compute chips toward high bandwidth memory is already well underway. The companies positioned at the intersection of AI infrastructure and memory production are the ones seeing demand that simply cannot be satisfied fast enough right now. Now, there is a risk worth naming honestly. Valuations in this sector have expanded significantly. That 81.5% year-to-date gain means expectations are priced in at elevated levels. Any slowdown in AI spending, any geopolitical disruption to supply chains, or any earnings miss in a major name could trigger a sharp pullback. Investing in a theme after significant gains always requires more patience than entering earlier. The structural case does not mean the path is straight up from here. It means the long-term direction of demand has not changed. That is a different kind of confidence than momentum chasing. This week, the market is celebrating SpaceX. It is watching the Iran ceasefire headlines. It is tracking the S&P 500 near record levels. And all of those things matter. But the 81.5% number sitting inside the semiconductor index this year is quietly telling a more important story. It is telling you exactly where AI spending is physically landing. Not in press releases, not in product announcements, in actual returns. The people paying close attention to that number right now will understand the next phase of this market better than the people only watching the headline indices. That is what the data is showing. What you do with that information is entirely up to you.